Hi, I'm Nora Hanna, the Executive Director of the Arizona Together for Impact Fund, and I want to welcome you to part 2 of our series on Show Me the Money, how to evaluate the financial strength of a partner, a potential collaborator. And if you haven't seen the first part of this, you can find it on our website. I'd encourage you to do that, although you don't necessarily need to look at these in sequence, but it might be helpful because we do build on some of the materials that we covered in our meeting a few weeks ago. And when we had that meeting a few weeks ago, several questions came up from the group and answers from the group as well. One of the questions was about, is there a checklist or a way we can go through? Because there was so much material you need to understand about a potential partner. And the answer is yes, there's a lot of great resources out there. One of which comes from the La Piana group. And they're a national consulting group who specializes really in this area of strategic restructuring, strategic planning, and mergers in particular. They have a couple of books out there that are really workbooks, they're toolkits. This is one of them. And it has, as you can see from my Post-it notes, all sorts of great tools and checklists in there, including one about doing your financial due diligence. And they have a second book as well that if you're going through with an integration of a program or a merger of some sort, this next one is kind of phase 2 about how to ensure that you do a great integration with your organizations. And one more pitch for La Piana, if you don't want to go to Amazon and buy the books, is if you go onto their website, they actually have a toolkit that you can download from their website directly. The cover of it looks like this, the Merger and Alliance Toolkit. It's about 26 pages long and it's free. And in there are links within it, embedded in it for every step along the way. They're really great about sharing their decades of learning in this area. And one of the things you can download is essentially, all the due diligence items you need in your checklist. And of course, the financial part is one of these. Interestingly enough, they don't talk a lot about cash flow, which we are going to talk about quite extensively today. They do mention budgets and financial statements, which we have covered, and we'll have some better examples as we move through our discussion this afternoon. So those are resources to look up. Again, you can purchase the books on Amazon, or you can get the free 26-page toolkit online. I would recommend them all. They're terrific. To proceed now to our discussion today, Leslie Pintor, who is the Executive Director of the Growth Partnership in Tucson, which is the CDFI, very interesting financial institution that loans money often to nonprofits as well as to for-profit organizations. So Leslie, who did a phenomenal job a few weeks ago, really understands how to assess the financial strength of an organization because, of course, they have to go through all the creditworthiness that might be needed to uncover whether she and her organization want to give them a loan. Leslie and I have a lot in common. We're both financial geeks and love spreadsheets and could spend hours in them. So I know that's not common for everyone, but it's certainly true of the two of us. And so with that, Leslie, I'm going to turn it over to you for today's discussion, and I will jump in as needed. Thanks so much.
And I geek out on Excel spreadsheets too, and I saw that Kristen said the same thing. So yes, it's good to have people like us. But not everybody is, and you don't have to be to understand or at least be able to wrap your arms around some of this stuff. So we won't get too much in the nitty-gritty details, but knowing and understanding financials and reading financial statements and things, it's like another language. And so it's just a matter of understanding what you're looking at and what you're looking for. So I'm going to share my screen here for the PowerPoint. And okay, I forgot to pick one of those. All right, here we go. So Nora did a good job of recapping what we talked about last time. We introduced balance sheet, we introduced the income statement. Today, in a little bit, we're going to tie those two together with, as Nora said, the cash flow statement. And that cash flow statement's the one that ties the two together and really helps you understand. But we're going to talk about a couple of other things before we get there. Today, our objectives are to cover audit letters and audit footnotes, so that if you get those kinds of financial statements from another organization, or if you have them yourself, but you're not really sure what is included in and why in this huge, big financial statement, we'll talk about that. We will talk about cash flow, give you some examples. We'll circle back to financial culture. We did talk about that a little bit last time and how important it is to understand that. And then that'll wrap it up for today. So warning, lots of numbers ahead, and it's going to stretch your brain, particularly if you're not a financial person. It's going to, don't be scared. You are going to be a little bit flummoxed by a couple of things. And then the hope is by the end of our, not so scary. So what is an audit cover letter? Well, it's financial statement is,
Leslie,
yeah,
you're cutting out a lot.
okay, I'm gonna undo.
Well, some of us, maybe if some of us, yeah.
I turned off my video, sometimes that helps. Does that help?
So far, yeah.
Okay. So it'll describe the type of statement that is following. So you may have a financial statement that's compiled, and so it'll tell you that, okay, well, what the heck is a compilation versus a review versus an audit? Well, that describes the level of detail that the accountants go through to verify the information that the organization is reporting. So a compilation is really just a restatement of whatever the company has already provided, and it's put into a little bit different format, but the accountants don't necessarily verify the data. A review goes a step further and kind of spot checks some things, and they review certain things. So you know that the auditors have dug in a little bit deeper into the financials. An audit is the most comprehensive kind of financial statement you can get. And that's where the accountants are testing all kinds of systems within the organization. And they're checking all sorts of journal entries and reconciliations. And they're just making sure that the organization has crossed every T and dotted every I. So it's the most comprehensive, it's the most expensive, and it's the one that you can have the highest level of confidence in as an independent presentation of the organization's financials. The letter also tells you about the rules they followed to prepare the statement. Most of the time, that's pretty boilerplate stuff. The most important parts are the last two, frankly, and that's where the accountants give you an opinion on the reliability of the financial statements, and any assumptions that they have are outlined in the notes, which we'll talk about as well. So there's really a couple of things to focus on very specifically in the audit cover letter. So I'm going to jump over to an example to show you. And of course, I'm doing the wrong thing here. Here's our sample cover letter. So here's the auditor's report, blah, blah, blah. The first part is, very, very standard. These are the time periods that we reviewed. We're just saying, little disclaimer, management's responsible for them. Here's what the auditor is responsible for, and these are some of the processes we went through. Again, most of this is boilerplate, and you can kind of skim through that. Here's the important part, the opinion. You want it to say that the financial statements referred to are presented fairly in all material aspects. Okay, you want it to say that. The next part is, and you don't want it really to say anything else, okay? There aren't any disclaimers noted in here. So this is the kind you want to see. We've previously audited. in our opinion, this presents the material appropriately, period. That's what we call a clean audit. But I'm going to show you an example of another one that's not so clean, prepared by a different accounting firm. So you'll see a lot of similarities. The titles of the paragraphs are the same. They pretty much probably read virtually identically. Here's what the auditors are responsible for, what they've done. Again, boilerplate for the most part. Here we are in the opinion. In our opinion, it presents fairly the financial statements, but there's a paragraph here that says uncertainties regarding the future. And in this particular case, the auditors are noting that there's some doubt about the ability of this organization to continue as a going concern. And so you'll hear people say, oh, this is a going concern disclaimer or something like that, but you want to look out for that kind of a paragraph because that's a big red flag, big red flag. So read the cover letter. Most of it's boilerplate. There's a couple of paragraphs that are really important to hone in on. Okay, so now I'm going to go back and share here. Okay, there we go. So now let's talk about the footnotes. This is really where it gets fun if you're a geek like Nora and me. The footnotes are all in the back of the financial statements, and they can be, they can cover all sorts of things. I'm listing here the top 10. This list of top 10 came from Dummies for, one of the dummy books for auditors or audit and accounting stuff. So these are the top 10 that you are most likely to see in an audit. Again, the basis for presentation, significant accounting policies that the organization has, because you can have different accounting policies. Let's take depreciation. You could depreciate your assets on the last in, first out method, or you could do it by the first in, first out method. So they'll describe all of that, kind of give you the roadmap, if you will. And I'm going to show you some examples here in a minute too. Many of you or many of your clients may not have inventory, but some might. The nice thing about the footnotes is things like depreciating assets, valuing inventory, employee benefits, consolidating the financial statements. What it does is it provides you more detail than what you're going to see in just looking at the plain old financial statements. And we'll see an example of that here in a minute.
And you know, Leslie, I would add in here, to me, the most important one you have on here is contingencies.
Yes.
Because there's, you know, I took a job at a corporation running it, believe it or not, and got in there. They did not have an audit, and there was a $250,000 contingent liability for sales taxes. The good news is in the nonprofit field, most organizations, particularly if they're $1 million or larger, have an audit or a review. But a contingency is something that you might not find any other place but in the audit footnotes. It may not be on the financial statements anywhere, and it won't be disclosed in some other way because it's just that. No one really knows what the outcome's going to be.
Yeah, really, really good point. Another thing, particularly in the for-profit world, that shows up there is lawsuits, pending lawsuits and
Right.
things. We don't know how this is going to turn out. So anything that's kind of an uncertainty that may not, it's not appropriate to put it in the financial statements yet because it's an unknown, it should show there. Another category that's important to look at is subsequent events. As you all know, if your fiscal year ends June 30, you may not get your audit finished until December, January. And so a lot can happen between July 1st and when the statements actually are issued. And so the subsequent events section will tell you about things that the auditors are aware of that happened after the close of the financial reporting period, but in time for them to at least make some sort of a comment on it. So let's take a look at a couple of these notes. I put note number 1 on there because, again, nature of activities, that's basically going to tell you the general gist of what the organization does, what its mission is. And so you need to make sure when you're having your audit done that that reflects what you want it to reflect. So make sure that you're working with your auditors on that. The significant accounting policies, again, can be a really important thing to look at, because perhaps an organization you're looking at joining up with does some of these things differently than you do. And so it's important to know those differences and then to talk about those differences and how that might, that's where you need to get your accounting and finance people involved, how that might change what everything looks like the next time around. That gets pretty nitty gritty into accounting stuff, and we won't dig into that too far. But a minute ago, I was talking about how the footnotes really give you the details. So in an audited financial statement, you are going to see property, plant, and equipment just as a lump sum number. And so you aren't going to be able to tell, well, what makes up that number. The footnotes are going to tell you how much. Okay, so we know from this footnote that this organization owns real estate and has a bunch of equipment as well. It's nice to know that it's real estate and not just a bunch of equipment, or I'm trying to think of what could be out there. If you're a kind of an organization that does school supplies, maybe you have, I don't know, maybe you have a bunch of computers. So it's nice to see what the difference is here. The other line that's important to look at is the accumulated depreciation line. This is kind of a mysterious concept in some ways, but as you all know, that's you're reducing the value of your assets on an annual basis based on the useful life of that asset. So if you see accumulated depreciation that's very high compared to the book value, that indicates to me that this organization is at the end of the useful life of those assets, and there may need to be some purchases that need to be made. There may be deferred maintenance things going on. So it's kind of a nice number to look at and ask questions about. This presentation for property and equipment is very similar then to what you're going to see on pledges receivable, notes payable, in-kind contributions. The footnotes are going to show you the details and really give you a much better understanding of what's going on in an organization. Another key one to look at is the temporarily restricted net assets or permanently restricted net assets. And there have been some accounting changes to these concepts in recent years, but the ideas are still the same. This is basically reconciling what's happened in your net assets account. So what did it start at the beginning of the year? Did you have excess revenue at the end of the year that you could contribute? Did you have this organization here had some bad debt losses or releases? Perhaps they weren't able to collect all their capital campaign. I'm not an accountant by training, so some of this stuff gets a little wonky for me. But the point is, you can reconcile and see how the organization is generating net assets and then maybe needing to use them for other reasons. I'd ask a lot of questions about this releases and bad debt losses column. Nora, do you have any thoughts?
No, I would guess that's exactly what it is. And it's it speaks a little bit to how nonprofit accounting is different from for-profit accounting in terms of when you recognize income. So you get these pledges and you have to recognize them as income, but are they collectible? It's a whole nother piece. Very interesting.
Yeah, and so it's again, thank you. It's again an opportunity to ask questions, and that's kind of the main theme behind this whole presentation that we're doing. In this case, we had a subsequent event. So the accountants are telling us what happened after the fact. And the reason this is good is because sometimes, and I don't think I have this as an example in here, but if the organization has loans, there is a footnote that will explain all of those loans, who the lender is, what the interest rate is, what the term is, what the payments are. It gives you all that detail. Well, if my fiscal year end is June 30 and one of my loans matures October 1st, and I don't get the audit until January, gee, I want to know what happened to that loan that matured October 1st. So likely it's addressed in the subsequent events, okay? And then the second paragraph is kind of, again, a disclaimer kind of a thing, basically saying we've included everything we know about through this particular date. So, questions so far? The notes to the financial statements are just really a gold mine of information and can really help you fill in some blanks, formulate some really good questions for some excellent dialogue. Nora, do we have any questions out there?
Nope.
No. Oh, you guys are great. Or it's that
Trucking.
one or the other. Okay, let's keep going. Let's jump back into the actual financial statements then. So if you'll recall from last time, we talked about how on the income statement side, or the P&L, whatever you want to call it, income is your revenues coming in, expenses are your costs going out, but that's not necessarily the same as cash flow. As Nora just mentioned, you may receive a grant award, or you may receive a pledge and you record that as revenue, but you haven't gotten the cash yet. And that's why the cash flow statement is so crucial. So we need to always keep that in mind, that the income statement or the P&L, whatever you want to call it, is not the same as cash flow. And it could look really, really good one year and really bad another year because of the way grants and pledges get recorded. But the more important thing is the cash flow and the ability to pay bills every month, okay? And a refresher on the balance sheet, remember that that is a specific point in time as of the date that it's prepared. The P&L or the income statement is over a period of time. So you need to understand both. What date is this as of and what period does it cover? And then the cash flow statement is the one statement that connects the balance sheet to the P&L, because the P&L takes place over a period of time and your balance sheet is a point in time. That cash flow statement connects it all and helps you understand how we got from point A, the beginning of the reporting period, to point B at the end of the reporting period. So I'm going to show you, well, we'll get there in a minute. So the cash flow statement, and I got to tell you, so I have a finance background, I have a finance degree, have worked in finance my entire life, and I will tell you that the cash flow statement for me was a really hard concept for me to get my head wrapped around for kind of a long time. So if this is a confusing concept to you, don't worry about it, you're not alone. So let's just understand conceptually what it's trying to tell us. It starts with the change in net assets, okay? That's basically the bottom line on your P&L. At the end of the year, did you have excess or were you in the hole? Okay, so that's where the cash flow statement starts. It says, okay, this year we had net excess revenues of $10,000, yippee, how did we get there? The bottom of the cash flow statement ends with your cash balance. Okay, so it's going to walk us through how we got from the change in net assets to our cash balance at the end of the year. What happened? Now this is where it gets really confusing. The numbers in brackets, this first part isn't so confusing. We're used to that. That's kind of a negative, right? That's a use of cash. Positive numbers are sources of cash. Okay, so it gets a little weird when you talk about certain line items being sources and uses of cash. So conceptually, I think this is probably fairly easy for everybody to get their heads wrapped around. It gets a little more confusing when we look at an example. Okay, so let's do a new share. And let's go over to our simple cash flow. All right, so we're starting with our change in net assets. So this organization had net excess revenues of $68,000 at the end of the year. Remember that the positive numbers add to our cash flow and the negative numbers take away from our cash flow. That's the easy part. It's the naming of it. So here's that depreciation and amortization thing. That is a non-cash thing that happens on your balance sheet, right? I mean, on your income, well, yeah, on your balance sheet and your income statement. So in this particular year, in 2014, this organization had depreciation of over $100,000. Well, that didn't really use any cash or create any cash per se, because no cash went anywhere. But for purposes of the P&L, it showed up as an expense, right? Depreciation shows up an expense on your P&L, but it really wasn't a cash expense. So we're going to add it back in. Okay. Accounts receivable went down by $1,500. Okay. That's showing that it's what? A use of cash, right? Well, what does that mean? Accounts receivable being a use of cash means accounts receivable went up. It went up, meaning you didn't get the cash, you have more receivables. Same thing with grants. Your grants receivable was a use of cash, meaning grants receivable went up, you didn't get any cash. See what I mean, how confusing this can be? Here's the big one, pledges receivable. This organization collected $217,000 in pledges in 2014 because it was an increase to their cash. Accounts payable went down by $31,000, which means it was a use of cash, which means they paid down payables. So if you went back to the balance sheet, you looked at payables at the beginning of the year and payables at the end of the year, they went down by $31,000. So I won't go through all the line items. That's the general gist of it. The statement goes through 3 categories of cash flow. You start with operating activities up here at the top, which is the normal everyday operations of the organization. Then you get down here to investing activities, and that would be buying equipment or buying a new building. We won't get into the details of that. And then financing activities. So this is really interesting. This organization received some contributions and then drew on a line of credit for $25,000, but they repaid almost $42,000 in a line of credit, and they paid $88,000 on their debt. So that used up a bunch of cash. So bottom line, through the course of the year, they added to their cash balances. And you can kind of quickly see, looking at the pluses and minuses up above, where most of those, where the increase came in. Okay, if we look back, we added $214,000 in cash to our account. Well, where did it mostly come from? It mostly came from the pledges collected and the depreciation. Now, how many of you are like really, really confused? Don't feel bad. It's very confusing. Like I said, it took me several years to really get my head wrapped around these concepts. My recommendation to you, if you're looking at one of these, is to highlight the big numbers and then compare those particular line items to the balance sheet from one period to the next, usually a year. Compare the two, and it might make a little bit more sense at that point.
And I think looking at, if you scroll back a little bit there, like that pledges receivable, you know, not only is it a big number, it's very different from the previous year. So there was some big campaign, there was something that went through, you know, things like when they're widely variable for year over year, that's something that I sort of say, you know, I want to find out a little bit more about that.
Yes. Yes, really good point. The trend analysis is really key, really, really key. And you keep going down here, you see on the financing activities, the year prior, they got $440,000 in contributions. So it's a very useful tool, again, to create more questions and conversation. Are some of these things pretty typical for the organization, or are there things that are kind of unusual? Notice this one thing up here, this 57,000 in forgiveness of accrued wages. That is like, what's that? I got to ask about that. It's a complex concept, but if you just stick to looking at key numbers, asking some questions, going back and looking at the balance sheet, you'll be able to see, make a little bit more sense of it.
Leslie, there's a question that came in before, but it could relate to this as well, which is, the question is about, do you get auditors who aren't familiar with nonprofit accounting? Which is one question, but I also think, I have had differing opinions on how to report things from auditor to auditor.
Yeah.
And so these aren't 100% consistent. I mean, right now, one of the debates that I have been involved with involves PPP money. So, do you continue to carry that as a liability if you haven't gotten the forgiveness, or do you recognize it? And I have two auditors debating it. So it's an interesting question that not all auditors behave the same, but I would highly recommend you get one familiar with nonprofit accounting.
Definitely. And there are a lot of them out there who do specialize in nonprofits. And, now that we're talking about this, it kind of makes sense, kind of like with your personal insurance and your cable bill and things like that. You really ought to go out to bid every couple of years, every 2 or 3 years, and make sure that you that you're getting the best representation that you can get. Because as you know, you're providing these audits to funders and grantors and all sorts of people. And if sometimes this is all they have about you to learn about you. So you want to make sure that you are comfortable with who's doing the work for you. So good point. Thank you. Was there another question?
Nope, that's all we have so far.
Okay, great. Let's keep going then. And I think I got a little out of order here. Okay, so then we talked about this, we talked about that, we got the example. Okay, so now, what about the budget? Well, you definitely want to understand what the other organization's budgeting process is. And, how does that work? Does the executive level team do all the budgeting? Do the program directors and all the different departments, do they do their own budget and roll it up to a bigger one? How does it work? What's the process that they go through to do their budgeting? And then you always want to ask for a budget to actual comparison of the current year and probably the last year too, because you want to see, well, how far off are they? How tightly do they run a budget? So for example, my fiscal year ended yesterday. And so I just got my new fiscal year budget approved by my board last week. And I explained to them, I said, let me tell you my approach to budgeting. My approach is I underestimate on revenue and I overestimate on expenses. And I do not do a zero-based budget. I still want to have a positive number down at the bottom because we need to continue building reserves. And so they needed to understand my mindset as to how I approach budgeting. Somebody else may approach it a little bit differently. So you want to understand that. And then you want to look at, well, how good are they at doing their budgeting? Are they way off on revenues? And if so, why? So for example, my last year budget, I had been on the job 2 months when I had to create it. I didn't know what the heck I was doing. So I created 2 budgets. I created a base case budget, which was kind of my worst case scenario. And then I created my WAG budget, right? Not my WAG, but my very aspirational budget. Let's put it that way. And so we ended up the fiscal year somewhere in between, which is where I wanted to be, but I was closer to the base budget than I was to the very aspirational budget. So how do people approach that? and how far off are they and why? Were they things in their control, out of their control? Are they just not good at budgeting? And again, an opportunity to ask lots of questions. What about, what do you think so far? Anybody have any questions? Okay. That's kind of it for the nitty gritty number stuff until we're gonna look. Do you want to look at a sample, the sample cash flow right now?
Yeah,
Laura?
I think so, because I think the budget, and I have seen organizations do budgeting in a variety of ways. Some of them budget all 12 months. And they're different, right? Because, you know, things are cyclical, like grants come in a big lump. But other organizations just budget for the year and divide by 12. And this is why I find a cash flow is particularly helpful. And do you want me to go through this one that you have put up here, Leslie?
Sure. I just want to make this statement about a cash flow in this particular format, which, by the way, I have I've provided Nora with a sample template that she's going to share so that you can start doing this yourself. This looks very intimidating and scary too, but here's how I look at this cash flow. This is basically like looking at your checking account, right? These are the real cash ins and outs on a monthly basis. And so this is no different than how you are managing or looking at your household budget. You probably just don't do a spreadsheet. You've got it in your head and stuff like that. But that's the concept here. There's no fancy accounting things you need to know to do a cash flow statement. It is really, what do you think the real cash coming in? So if you've got pledges and they're showing up in your pledge receivable line item, when's that going to come in? Is some of it going to come in February and some in August, and nothing's going to come in for 3 months? This is where you have the opportunity to do that, and it really helps you manage that cash flow and will really help. The idea is to be managing away from negative lines down there, net cash flow, to more positive, so that the CEO, the ED, the head of accounting, the CFO, they don't have to lose sleep at night. And it's easier to manage. So yes, please, Nora.
Yeah, I won't take too long. And just as Leslie pointed out, she has a sample cash flow model that is fillable with some notes about how to fill it in, which I think is terrific. So we'll be posting that up on our website so you can take a look at it. I just anonymized one that is a, very, it's simple to me, one that we used in a couple of different organizations I was involved with. And I felt, from a management perspective, this is what I needed to have my hands on what was happening within the organization. That a budget and a financial statement, you're looking backwards. So this is what happened, most of which I know. The question is, what's going to happen, and how can we look at that predictively? And things don't flow in just this, in my experience, of divide by 12. So I really need to understand, and cash is king as far as I'm concerned, particularly in the nonprofit sector. You need to have enough cash to make sure you're going to make your payroll, and make sure you have enough to get through the dips. And a lot of the work we do is cyclical. So in this case, for example, so I have the revenue on these first two sections, and I separated kind of earned from contributed, and they come in a variety of different ways. But if you look at, program 1, program 2, program 3, you can see, I think it is under program 2, there's no revenue for the first half of the year. It all comes in July through December. So is it a school-based program? What's the nature of that program? Why is it coming in this cyclical way? Similarly, you can look at things like a special event. I typically consider that earned, although you probably put it under contributed for most cases. But you could see where you're going to have these events at a certain time of the year, and if the organization is just doing it in a lump, it's very hard to see that, well, we're going to lose money over the summer, but we have our big event in October. It's sort of not meaningful during COVID, but we have our big event in October, and from that we receive $300,000. Well, I would really need to see how deep is the dip in the summer, and when is it going to right itself. So Leslie, I'm just going to ask you to scroll down a little bit, and we can post a sample so you can see it. You know, you can see there's cash at the beginning of the year of that $500,000 nearly, and then a series of losses. And a lot of times we have restricted cash, right? We're given the money from grants. The type of grants I used to get were often came in during Q4. So we get them at the end of the year for the following calendar year. Lots of times we had cash at the end of the year, but we were going to have to spend that cash on the programs that we had committed to. So I always really wanted to know how much cash would I have during these lost months, and when was that going to come back and even out? And so if you're really good at this, you're managing it by restricted and unrestricted cash. The other thing I like to understand is, do they have a cash reserve? And do they have a policy around cash reserves? So are they dipping into their reserves regularly, or do they have funds that they keep, you know, aside for it? And the last piece I have on here is, you know, if they did a cash flow projection, and I think you saw at the top, I was putting actuals in for some of the months and keeping projections. So how accurate were they? Are they good at projecting their own cash flow? So what did they originally project? And I will just say, for me, this was the most important document that I would operate with and share with my board every month. This was just a one-pager, and it told the entire story. What were the big variances compared to what we had projected, and where did we think we were going for the balance of the year? And I usually recommend that you have this as a running cash flow, so you have a 12-month forward look. So when you're dealing with a prospective partner, I'd really want to understand what kind of grasp they have on their own cash and their cash needs, and what they're going to need moving forward to get through whatever cycles they might have in their business. Yeah, so I think that's really all I'm going to say about that. I don't know, Leslie, do you want to put the sample one up, or we'll just post it on the site?
I've been showing it while you've been talking.
No, I meant the fillable form that you're going to share.
Oh, I don't have that.
Okay, no problem. That's not a problem at all.
Nora, I really like this because I like that you're showing down here your cash reserve, you know, and so while it got scary here for a period of time where you got down to $2,300 in cash in the operating account one month, you still had that $200,000 cash reserve here, so that your bank statement, you know, you still had that cushion. And so I think it's really, really important to ask not only your own organization, but any potential partner, do you have a cash reserve? What's your policy, or what's your what are you shooting for? Because had this organization not had that $200,000 cash reserve, it had been really scary.
Right.
And that's important too. Are there cash reserves? What are they? What are you shooting for? Is it 3 months? Is it a specific dollar amount? Is it whatever? A specific dollar amount is kind of nice because it's very easy to quantify.
Yeah, and typically what I have seen a lot of, in particular, consultants who work on the financial side with nonprofits, and they often prepare a dashboard. They like to see how many months of cash do you have on hand that if no revenue came in, you would be able to operate. So I usually, for those purposes, go through my fixed costs, you know, my payroll and things that I know I'm going to have, and figure out what that is for 3 months or 6 months. And that's often the basis for a cash reserve model. We want 3 months of operating cash reserves. So what is that? What would you absolutely have to have if no revenue was coming in?
Yep, exactly. Great. Does anybody have any questions about this? This is a really great tool. Really great.
I have a question. What's the general rule of thumb for the amount of cash reserves to cover operating costs? Is it 3 months, 6 months? I mean, especially now, given the downturn due to COVID, what would you say might be how many months of operation do you think, as a rule of thumb?
Yeah, I don't know that there is a rule of thumb. I would say 3 to 6, but some of that depends on the nature of the nonprofit. In other words, if they only operate on, say, grant revenue, and grants aren't consistent year to year to year, I would want a bigger operating reserve because they don't have consistent income. And so they can't count on that sort of thing. Or if they don't have earned income, if it's a heavy earned income nonprofit, or they have government grants that are fairly consistent for a reimbursement, it's a little, sometimes can be less risky. So I find that nonprofits have different policies around that depending on their revenue source. But I would say 3 to 6 months would be fairly normal. Ideally, in a great world, you'd have 6 to 12.
Mhm. Agreed. I agree with Nora. I think it depends a lot exactly on what Nora said. For my organization, we have, for our CDFI certification, we have to have a minimum of 3 months. But I think part of that too is going back to your financial, your culture, your financial culture. What are you comfortable with? What's leadership comfortable with? What's the board comfortable with? And perhaps 3 months, even though that might be good enough, maybe your leadership just isn't very comfortable with that and they want 6 months, or you can aspire to 6 months. I mean, wouldn't we all love to have 12 months cash reserves? But then you also have to, balance that with mission and all of that sort of stuff. So it's a conversation worth having for sure, not only with a potential partner, but with your own board and leadership. We just had this conversation internally ourselves, and we decided not to create a specific written policy, but we have our target and the metrics that we're measuring every month. And we have we have a minimum target and we have an aspirational target.
And Leslie, there's a comment here that I think is excellent and really plays into the work you do. If they don't have a line of credit to cover those dips, then it's more important to have a larger cash reserve. Sometimes
Absolutely.
if you have assets that you can use as collateral. So in her example, she had a nonprofit that had some buildings, and let's say they didn't have much debt on those buildings. They might have an operating line of credit
Yes.
on which they could draw to fund those things. But that's part of what you offer.
Yes, we don't specifically offer lines of credit that you can draw up and pay down and drop and pay down. What we have done for several nonprofits who have cyclical cash flow is we will do a bridge loan. So if you look at this example that we were just talking about here, right? So there are several months of negative net cash flow here. So oftentimes we'll do a loan to cover those shortfalls, and it's just a lump sum at the beginning. You put it in the bank account. Yes, you're paying some interest, but it's a cost of doing business and actually well worth it to know that you have the money available. And then once all the cash starts coming in, then the loan is due and payable. And we do that annually. I've got a school that we do that annually with because their tuition and monies from the tax credit money comes in at certain times of the year, but they've got to pay bills the rest of the year. So yes, exactly. That's what a line of credit is for. And it's worth having. If you can qualify for a line of credit with a bank, do it, get it. It's insurance. It generally doesn't cost very much to have it. It's a nice insurance policy for sure. Good question, good comment. Okay, I know we only have a few minutes left, so let's keep going. Really wanted to just circle back. I was forget to do my other screen sharing. Okay, so circling back to just kind of the big picture thing again here. What is it that you need to understand about each other? what are the strengths and weaknesses? And we're focusing here on financial stuff, right? So what are the strengths and weaknesses of each of the organizations from a financial standpoint? And what about the financial culture? We've gone through all of this analysis and looked at all of these documents, asked all these questions. What did you learn about how they operate financially? And how will that approach integrate with your team? And what will you do to overcome any differences that you come up with? Who's going to take the lead on that? The bottom line is it's really all about process. Understanding the processes that organizations go through and how they think about things is going to really help you understand the financial piece of it. Because if you'll recall at the very beginning of our first segment together, I said every decision is a financial decision, and every decision that an organization makes is reflected in some way, shape, or form in all of those financial statements we've been looking at and all of the footnotes. So understanding the process and how they approach their operations will tell you a lot. And answering those questions at the very end of it is really important. So I'm going to skip the questions for just a second and just highlight again the key takeaways from not only today, but prior session as well. Hopefully through this couple of webinars, you've learned more about how to dig in and understand both the finance and accounting cultures of another organization and maybe your own. How to review the financial reports and what to look for to compile questions and ask lots of questions. It's like detective work. If any of you used to watch Columbo, or he was dumb like a fox, right? Don't feel like any question is dumb, because you and your organization, you know everything inside and out. You just presume either everybody else does it the same way you do it, or you just don't even think to tell people certain things. So it's important to ask all of those questions. And then as you're going through this process, if you get stumped or stuck and just want some help reviewing a financial statement, or you're not quite clear about what we talked about today, I'm always available to answer questions and talk through things with you. That's what I'm here for. That's part of our mission, is to help nonprofit organizations with their long-term financial sustainability. And it doesn't always have to be through a loan. So sometimes it's just a matter of education and helping people work through their situations. So with that, I'm going to stop and see if anybody has any questions. Make sure you know how to reach me. If you do have questions, of course, you can always just go to our website. You can find me. Many of you on the call already know how to find me. And see if there's any last questions before we wrap up.
We do. We have a question here, and I also have a story I want to tell. But the question relates to, we talked a little bit about it a couple of weeks ago, but how do the 990s and what's reported on the 990 relate to the financial reports? What should they be looking for?
That's a good question, because 990s, I mean, tax accounting is a completely different language beyond the language of GAAP accounting. And so it can be really, really hard to decipher a 990. Nora last session mentioned that one of the key things to do is just kind of look at both of them, see how different they are. And if there are some big, huge gaping differences, ask questions. You'll find big differences usually happen in depreciation. That's a big one. I'm not as an expert on tax accounting as maybe you are, Nora, but read the narrative parts of the tax return. And I learned at a workshop a year or so ago, make sure with your tax accountants, who may or may not be the same as your auditors, make sure that you write the narrative part about your organization, because again, that may be the only document, that 990 might be the only document that somebody knows about you other than your website. So you want to make sure it truly reflects your organization.
The experience I had recently is the 990 looked nothing like the audited financial statement, and I mean by a factor of 4 or 5. And it was all cleared up with a question, which was the financial statements were consolidated of multiple 501c3s. So, you know, you have a taxpayer ID number and you file a tax return usually for every taxpayer ID number, but they can be consolidated for an audit. So in this case, there were actually 3 different organizations, a real estate subsidiary, I think a school subsidiary, and some other ones that on the audited financial statement were all consolidated. And when I was only dealing with one of these, you know, nonprofits. And so the 990 was actually much more accurate to represent the one aspect that I was dealing with. I wasn't having anything to do with the real estate entity or the school. It was the operating nonprofit. So it does just spark more questions. And also, as boring as the footnotes are to the audit, the tax return is more boring. But definitely worth combing through. And I don't know how many of you read the newsletter. I'm sure all of you read my newsletter, but there was a story last time about Boys and Girls Club. And they recently had an integration of Metro and East Valley. And until they got into the financials, one of them had a school and the other one didn't even know they had a charter school at that one. So you start like, and it came out through the 990. So sometimes you just have to like go through and go, wait a minute. And that seems like not an important thing, but it ended up that to keep the charter, they had to keep that organization and they were planning to start a whole new organization. So you know, the tail can wag the dog on some of these things, and the more information you know, the better planning you can do as either a partner or a consultant working in these areas. So it is a little bit dry, but, you know, get some caffeine in you and read through this stuff and start making your list of questions. It's very, very helpful. And with that, we're just about out of time. Leslie, thank you so much. This was great information. And I loved that you had examples, live examples that you were able to share with us that made a huge difference. So we're very grateful. We will be sending our questions your way. And we'll post this as well as a couple of other documents. And I also, again, encourage you to go to the La Piana website. They give away a lot of their material. It is not hard to access. So definitely worth reaching out and getting that information. And with that, I think we'll wrap up. Thanks again. Good to see everyone.
Guys, nice to see everyone.
Bye.
Bye.